There are two ways to make money in the stock market. In the first way, you buy a stock and try to sell it to someone else at a profit. In the second way, you want to just hold a stock for a long period of time, profiting when the underlying value of that stock appreciates over time. Now, these are two very different ways to approach investing. And the first way, people will often refer to as trading and may not even consider it investing. And the second way, people will call very often long-term investing. Now, this channel focuses on long-term investing. And I'm going to talk about many reasons why I personally think long-term investing is the way to go. But I first want to note that when you are doing short-term investing, you can really only win when someone else loses. You're talking about there being one transaction with another party. And so there's kind of a limited amount of value that can be split. Now, don't get me wrong. Of course, markets are great, and the ability to transact in a market with liquidity is a huge benefit for society. Except when you personally are employing a strategy of trying to buy a stock with the express purpose of just hoping to sell it at a higher price later, what you are really doing is, in some sense, you're kind of hoping that there's a greater fool out there. You're kind of hoping that you were able to buy something cheap in order to sell it to someone else expensive. Now, I'm not making any sort of judgments about this. I myself have tried it when I was younger too, as well. Except I'm going to say one, it doesn't work very well and very consistently. And I'll say the second thing that you need to be aware of is the people that are going to say they're there to help you trade better or invest for the short term better are very often going to also have a sort of embedded incentive in making sure that you see things their way, because they can only win if they are proven correctly and in a very short amount of time. And if you think about the way a market works and the way a market prices stocks, in the short term, it is very much a voting machine. So what that means is that people's opinions about a stock will influence its price. And if you are a short-term investor and you don't want to own the thing for a long time, you are very concerned about what the price of the stock is going to be. Now, if you were listening to someone who owns a stock and says, I believe the price of this stock is going to go up, they need that price to go up quickly in order for them to make money, because the thing they are owning, they may not really understand, and it may not actually be growing in value over time. Now, you have to remember one of the biggest keys to investing is very simple. There's a difference between price and value. Now, we understand this when we go to a grocery store or any sort of retailer and buy something. We'll see certain items are on discount and we'll say, wow, that's a great value. And other items will seem overpriced. It doesn't seem like it's worth it. Stocks are no different, except a lot of people in the stock market want to play this game where they will buy a stock and try to convince other people that it should be a higher price. Sometimes they'll do this directly with a lot of social media and they'll put out research that maybe they themselves don't believe in. There's all sorts of scams that you need to be aware of that can happen in financial markets. But it also doesn't even need to be someone who is that unscrupulous. They could be genuine in owning a stock and thinking the price is going to go up, but just the very fact that they need it to means that they kind of have a little bit of a ticking time bomb on them, because they're not focused on the underlying value of the business. They're just very focused on the price. And price can be thought of as really no different than perception. And so they're concerned about other people's perceptions. And so what that means is that they have to argue a lot. They have to push out a specific narrative and try to convince you to buy into that. And so there's a whole motley crew of people that are on the internet that will talk about certain stocks and they want to convince you that they are right. Now, they may not have some sort of scam or any sort of scheme, but it is important for their success, though, to change the perception in quickly in order to make money off of that stock. Now, when you are truly investing, at least what I believe real investing is, you're not playing that game at all. What you are really focused on is the underlying value of a stock. Because a stock is really just a partial ownership in a business. And so you're buying a business. Most businesses, if they're good businesses, will grow in value over time. And that is how you make money, as the business grows in value over time, not by trying to sell your part ownership in the business to someone else at a higher price, and rather quickly too. Now, yes, this can be a slower way to invest, But also, generally speaking, it's less likely to get you into trouble. When you are buying something in hopes of selling it at a higher price, the thing that's supporting that price is not the value of the business, it's just perception. And so if perception changes, and it can change very quickly, then you are stuck holding something that could fall in price. And perception may never change back to the price it was at before that would allow you to make a profit. Now, when you are investing in a business and you're focusing on the underlying value of the business, what really matters is whether or not the business does well. If the business is creating value, then that over time will translate to cash flows. And as an owner in that business, you get a part of that cash flow. So over time, stock prices will follow cash flows. It just will not be a very sort of quick correlation. And sometimes it could be years before the two catch up. And that is your opportunity as a long-term investor. When there is this big disparity between the potential earnings power of a business, the value it can generate, and the price it goes for in the market, that is when you can step in as a long-term investor and buy something for the long term, making money because this business is going to make more value over time. If you think about it, when you are doing a single transaction with someone, like you do when you are trading, there's a limited amount of sort of value that you can split. And the more that one person wins, the more the other person loses. It is just my personal preference that I do not really like these sorts of games. Whereas in contrast, when you are a long-term investor, the value of a business can just continue to grow and grow and grow and grow. No one would have ever thought we've had multiple multi-trillion dollar companies now. And by the way, there's nothing stopping them from continuing to grow even more in the future. In fact, that is what is expected to happen. When you have a good business that makes money and it retains some of that money, it is basically investing on your behalf. And so it is expected that if these investments go well, it'll continue to grow. And so that is one of the reasons why I personally believe long-term investing is better. Because even if you don't have the best company and it's kind of only an okay company, it'll also tend to grow in value over time. Not every company will outperform the S&P 500, but even pretty average companies will be worth much more in the future than they are today. However, if you're just focusing on trading stocks or really short-term investing, you're not focusing on that value at all. And you have no idea what the perception is going to be of that stock. It could be much worse in the future and it could never recover. And so it is an entirely different game people are playing when they're focusing on the stock price rather than the value of a business. But I will say, though, it's also a lot harder to try to figure out what other people will pay for something in the future. And in fact, very few people have ever done it well. If you go to the Forbes list and look at all of the billionaires, very few, if any, are pure stock market speculators. George Soros and Stanley Druckenmiller are known as being some of the most successful traders, but even they themselves note that they were much more successful in currencies when there's sort of other fundamentals they could look at rather than in equity markets. But sure, if you think you're going to be the best of all time, then go try your hand at it. In contrast, you can see many people on Forbes that have built businesses over time. And where did their wealth come from? Simply holding the stock over time as it grew in value. And there were many periods where the price dropped well below what could be considered to be a fair valuation. But since they were investing for the long term, it didn't matter. Jeff Bezos' wealth has been cut down more than 50% many times in his journey to being a centibillionaire. If you invest for the long term, though, you're not concerned about these sorts of things. You're concerned about the business. You're looking at the fundamentals, the metrics. You want to understand what makes a business a good business, what allows it to create value. Because if you're creating value, then you're going to be generating cash flow. If you're generating cash flow, eventually it's going to be recognized by other people. And by the way, even if it's not, the company can always buy back stock, which can boost up those share prices, or it can issue a dividend, which also has a similar effect because people will look at the dividend yield. And if it's very high, they'll want to buy the stock. And so there are ways, as long as the business is a real good, valuable business, that the stock price will eventually be reflected. And so that is what this channel is about, learning how to understand how to invest in businesses. It is not about learning what is a good stock. It's about learning who do I want to partner with in business. When you are buying a stock, you are giving someone your money and they are investing it on your behalf. You go buy a share of Amazon and they are investing it on your behalf. And if they do a good job, it could be worth much more in the future. And so, in summary, there are only two ways you can make money in the stock market. Either you are buying something in hopes of selling it to someone else at a higher price, or you are owning an asset and you are making money while the underlying asset is appreciating in value. And in my opinion, that is a win-win, because when you own something that is growing in value, there's much more value for everyone. Whereas in contrast, if you're just doing one transaction, it's very limited the amount of gain you could get, and it usually comes at someone else's loss. And so that is why I personally prefer to focus on investing for the long term, because if you're just looking generally at the development of the economy over time, everyone in the world is wealthier. Yes, there's wealth disparities, but the world's wealth is much higher today than it was 100 years ago. And as a long-term investor, you are just participating in that trend. It's a lot like if a farmer had a handful of seeds. Would you want to focus on trading the seeds, or would you want to plant the seeds and wait for the harvest to split it? That is what long-term investing is. Waiting for the harvest is a lot like long-term investing. It requires a lot more patience, but over time, I personally believe it is more rewarding for all parties involved. If you want to learn more though about long-term investing, go ahead and hit subscribe, and there's a lot more that we can do in the future together. And if you have any questions, go ahead and drop them in the comments below. And if you enjoyed this video, please go ahead and leave it a like.